What is a bear market? Stock traders define bear markets as a drop of at least 20% in stock prices. The 1973-74 bear market was one of the sharpest across many countries. Stocks tumbled 68% in the UK, 48% in the US, and 53% in France. The 1973-74 bear market was connected with the 1973 oil crisis, as Arab oil exporters announced a total oil embargo against countries that had supported Israel in the 1973 Arab-Israeli War. What could you, individual investors, have done to avoid heavy losses in that bear market? Are these lessons applicable to other bear markets, such as the one we saw from 2000 to 2003? How about future bear markets, which will inevitably happen? Let's start our examination of the 1973-74 bear market with its context. The state of the world economy in 1973. Philip Davis explains that the early 1970s were a period of very fast economic growth in industrialized nations, with all G7 countries except Italy growing over 4% in the last quarter of 1972. Fast economic growth continued in most countries for much of 1973. And then came the shock. Robert Lacey writes that, on October 6, 1973, the Arab-Israeli War began when Egypt attacked Israel from the south, and Syria attacked from the north, attempting to recover land lost to Israel in 1967. King Faisal of Saudi Arabia supported Egypt, and stated he would provide aid to assist with the war effort, noting that he was also willing to use what he called the oil weapon, if necessary, to support Egypt. In the US, the war began at the height of the Watergate scandal. President Nixon largely let his head of foreign policy, Henry Kissinger, deal with the Arab-Israeli war, as Nixon was busy with Watergate. Robert Lacey continues. The plot thickened as the Soviet Union shipped weapons to both Syria and Egypt, prompting Nixon and Kissinger to frame the Arab-Israeli war more in terms of the Cold War, rather than Middle Eastern politics. Nixon then authorized Operation Nickel Grass, an airlift to deliver weapons and supplies to Israel. The Arabs also reacted. At the OPEC summit in Kuwait on October 16, the price of oil went from $3.01 to $5.12 per barrel. Why did they choose this reaction? The Saudi oil minister, Zaki Yamani, later explained in a 1981 interview,
"The king still wanted to give America a chance to stay out of the fighting. So we agreed to cut back production by just 5% per month. A full embargo, we agreed, was something we would implement only if we felt that things were absolutely hopeless."
Unfortunately for the whole world, the situation escalated quickly. Israel took heavy losses in the war and asked for $850 million worth of American arms. But Nixon requested $2.2 billion from Congress, which promptly approved the exaggerated figure. Nixon, who was being badly battered by the Watergate scandal, felt that a bold foreign policy move might resuscitate his administration. This enraged King Faisal, who also felt insulted that Nixon promised honorable peace the day before he submitted his huge request to Congress. And thus, on October 20th, the Saudis retaliated by placing a total embargo on oil shipments to the United States, to be joined by most of the other oil-producing Arab states. The embargo was accompanied by gradual monthly production cuts. By December, production had been cut to 25% of September levels. Kissinger later admitted about the arms lift and its consequences.
"I made a mistake. In retrospect, it was not the best considered decision we made."
By November 1973, oil exports from the Middle East to the West were down by 60%. And in December, OPEC announced at its Vienna conference that the barrel of oil was to increase from $5 to $11.65. Oil prices almost quadrupled in a few months, hurling the world into a deep recession. Philip Davis writes that economic prosperity in 1973 turned into a sharp recession in 1974. Inflation, which had been tame, also jumped across the board, topping 20% in Japan. Philip Davis shows the impact of the global recession on stocks. The oil shock sharply increased business costs, and business profits plunged. Demand declined, unemployment rose, and consumers spent less. The bear market lasted 2 years. Worst hit was the UK, where stocks plunged 68%. In real terms, considering inflation, stock markets took up to 20 years to find the next peak. If you are a fan of the 60-40 model, investing 60% of your money in stocks and 40% in bonds, you probably wonder whether this worked in the 1970s. It did not. Dimson and friends calculated the real returns for stocks and bonds from 1970 to 1979. You would have lost money on average across G7 countries. You would have made a little money only in a few countries. Remember, the 60-40 model might work in the very long run, but it does not guarantee that you will make money every decade. Our verified sources are shown here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. What are the takeaways for you? Extended bear markets are not the individual investor's best friend. As we've seen, investors generally did not do well in the 1970s. What can you do in such circumstances? Even if you decided to be very conservative, investing in bonds or cash only, you would still have ended the 1970s decade in the red in real terms, adjusting for inflation. What does this mean to you? Investing is a humbling activity, to the extent that results are never guaranteed, regardless of how much work you put in. Were there any asset classes that did not lose money in the 1970s? Commodities such as gold did well. So did some commodity-related stocks such as oil companies. After the 1970s, the next extended bear market came at the turn of the millennium. By late 2002, the bear market was not over yet, but the damage was as serious as in the 1970s. Worst hit was Germany, with a 65% plunge. Extended bear markets do not seem to happen often, but when they do, the damage is serious. What does that mean to you? Good habits such as diversification across asset classes and geographies, as well as avoiding leverage, do increase your probability of surviving extended bear markets, which tend to reappear every few decades. But these good habits do not guarantee you will make money in bear markets. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.